Today, I'll be talking about something that's on everyone's mind: a possible recession. Is one coming? And how do we know for sure? Recessions don't just happen overnight, there are always warning signs, but most people miss them until it's too late. Think about it: layoffs, inflation, stock market volatility. These are just a few indicators, but there are others, less obvious signs that can help you prepare before things take a turn for the worse. Most people don't pay attention until the economy is already in trouble, but those who see the signs early have the chance to protect their money, job, and future. So, let me ask you, are you prepared for a potential economic downturn? Today, we'll break down three major recession warning signs that you cannot afford to ignore and what you should do about them. Let's take a closer look. Sign number one: changes in bank lending practices. One of the key signs of an impending recession is when banks start tightening their lending standards. But why should you care? Let me explain. When the economy faces uncertainty or risks of slowing down, banks get cautious. Why? Because lending involves risk. And when banks feel that things could take a downturn, they start to protect themselves. They know that if the people can't pay back their loans, it could hurt their bottom line. So, what do? They make it harder for businesses and individuals to get loans. That's where the problem lies. Without easy access to credit, the consumer spending drops and business investment slows down. And guess what? Less spending and investing is equal to less economic activity. But how do you spot these changes? Well, there's an important tool that we can use: the Federal Reserve's reports on bank lending standards. Each quarter, the Federal Reserve releases its Senior Loan Officer Opinion Survey, which tracks whether banks are tightening or easing their lending criteria. This survey tells us if the banks are getting more selective about who they lend money to. For example, in the Q4 2023 report, we saw that banks tightened their lending in several key areas. 47% of the banks said that they had tightened standards for consumer loans. Think about mortgages and auto loans. And 56% of the banks reported making it harder for businesses to get loans. That's a big deal. It means that banks are expecting economic challenges ahead and we are becoming more cautious about lending money. Now, let us talk about the credit score requirements. When times get tough, the banks usually require higher credit scores to approve loans. If you notice that you're having a harder time getting approved, or that the banks are asking for higher credit scores, then that's a warning sign. For instance, during the 2008 financial crisis, we saw credit standards tighten drastically. Banks asked for higher credit scores, larger down payments, and even more detailed income verification. Another important thing to watch for: interest rates. When banks are worried, they often raise their rates. Higher rates means that it costs more to borrow money. And when borrowing becomes more expensive, people and businesses hold off on spending and expanding. So, here's the bottom line. When banks start tightening up, it's a clear warning sign that they foresee some rough economic waters ahead. If you start seeing higher credit score requirements, lower approval rates, or rising interest rates, that's your cue to start preparing for a potential recession. Sign number two: decrease in consumer confidence. Let's talk about another important sign of an impending recession: a decrease in consumer confidence. Now, why does this matter? Well, consumer confidence is a direct reflection of how people feel about the economy and their own financial security. When consumer confidence takes a hit, it's not just about feelings, it affects spending behavior, which drives a huge chunk of the economy. Think about it. When people feel uncertain about the future, whether it's because of job security, inflation, or market volatility, they start tightening their wallets. They hold off on big purchases like cars, homes, and major appliances. They even start cutting back on smaller everyday spending. When this happens on a large scale, businesses see a drop in earnings and the economy can slow down. So, how do you spot a decrease in consumer confidence? One of the best tools to track consumer confidence is the University of Michigan Consumer Sentiment Index. The index surveys people about their views on the economy, including their financial situation, job prospects, and the overall economic outlook. When this index starts to drop, it indicates that people are feeling less confident about their future, which often leads to reduced spending. For example, in 2022, the Consumer Sentiment Index hit its lowest level in over a decade, reflecting a sharp decline in consumer confidence. The drop was linked to rising inflation, supply chain issues, and fears of a potential recession. People were holding back on spending because they were concerned about the rising prices and job instability. But it's not just about the numbers. News reports can also give you some clues. Pay attention to stories about people postponing major purchases, whether it's a car, a home, or even a vacation. This behavior is a classic sign that consumer confidence is slipping. Another indicator to watch is retail sales data. When people become worried about their financial security, they stop spending time on non essential items. Retailers, especially in industries like luxury goods, travel, and big ticket items, may see their sales slow down. If you notice this happening, then it's a big red flag for potential economic trouble. In short, a drop in consumer confidence is often one of the first signs that people are preparing for a recession. When consumers start feeling uncertain about the future, they pull back on spending, and that can lead to a slowdown in the economy. So, if you see declining consumer sentiment or hear about people holding off on large purchases, take note. It might be the time to prepare for what's ahead. Sign number three: weakening housing market. One of the most telling signs of a potential recession is a weakening housing market. Now, why does this matter? Housing is a major part of consumer wealth, and for many, their home is their largest asset. When the housing market slows down, it can have ripple effects throughout the economy. Declining home sales and stagnant home prices often serve as early indicators of economic trouble. Housing significance lies in its connection to consumer wealth. When home prices fall or sales slow, homeowners feel less affluent, and this can lead to reduced spending in other areas. The housing market also has a direct impact on related industries such as construction, real estate, mortgages, and home improvement. A slowdown in home buying reduces the demand for new homes and renovations, which in turn affects jobs and economic activity in these sectors. In 2024, we are seeing early signs of a slowdown. Existing home sales in November 2024 rose to an annual rate of 4.15 million, which was the highest since March but still lower than the year before. Home prices also showed signs of deceleration, with the S&P Core Logic Chase Shiller Home Price Index reporting a 3.9% annual gain in December, but that's down from the 6.5% growth earlier in the year. This price slowdown indicates that demand for housing is starting to ease. Another indicator to watch is the mortgage delinquency rates. While the exact figures for 2024 are still being tracked, we have already seen some upticks in delinquencies, which signal financial strain among homeowners. Rising rates and high home prices have made it harder for some buyers to afford mortgages, and this is affecting their ability to keep up with the monthly payments. The housing market also directly impacts construction. As the demand for new homes decreases, home builders have been scaling back their activities. In 2024, the National Association of Home Builders saw a drop in their confidence index, reflecting the challenges that builders face due to high construction costs and uncertainty in the market. This slowdown is felt across the supply chain, with fewer homes being built and renovations taking a back seat. In addition, the broader real estate market is experiencing a shift. As more people stay put due to the high costs of buying a home, the real estate transaction volume has decreased. Mortgage rates have also fluctuated, with many homeowners reluctant to sell because they have locked in lower rates. This creates a domino effect where both the buyers and sellers are sitting on the sidelines, further stagnating the market. Looking ahead to 2025, the home values are expected to vary depending on location, with some areas predicting a 4.2% growth in home prices, while other regions may experience a slight decline. Mortgage rates are projected to ease slightly, but will likely remain volatile, which will continue to impact affordability for both the buyers and the sellers. In summary, a weakening housing market is a key indicator of broader economic issues. Keep an eye on home sales, price trends, and mortgage delinquencies, as these will give you early insight into potential economic challenges. If the housing market continues to slow down, it could be a sign that trouble is on the horizon for the economy as a whole. Final thoughts. It's important to stay proactive when it comes to your financial security. Economic changes like tightening bank lending practices, drops in consumer confidence, and weakening housing market can be all early signs of a potential recession. To protect yourself, start by building an emergency fund, reviewing your investments, and keeping up with the economic trends. Now is the time to make adjustments, whether that means cutting back on unnecessary spending, diversifying your investments, or simply staying informed about what's happening in the market. Being prepared is your best defense against any economic downturn. If you found this video helpful, then don't forget to subscribe for more insights on managing your finances. Also, I'd love to hear your thoughts. Drop a comment below and let's keep that conversation going. Stay informed, stay prepared, and take full control of your financial future. I will see you all in the next video. Bye.